Breaking news: thousands of UK savers could soon face unexpected tax bills simply for having £7,500 sitting in a savings account. Yes, you heard that right. In a surprising twist, the HMRC under the new Labour government is reportedly eyeing ordinary households who are doing nothing more than what they thought was sensible, saving money. This latest warning comes from personal finance experts who say many savers could be caught out by little-known tax rules, particularly those who believe their savings are completely safe from tax just because they're below a certain amount. But there's more to it than meets the eye, and unfortunately, the devil is in the detail. Let's break this down. So, what's the issue here? Why is having £7,500 in a savings account suddenly a potential problem? Under the current tax system, the government offers something called a Personal Savings Allowance, PSA. This allowance lets you earn a certain amount of interest from your savings without paying any tax on it. Sounds good, right? Well, it is, but only if you stay within the limits. Basic rate taxpayers can earn up to £1,000 in interest per year without being taxed. If you're a higher rate taxpayer, that allowance shrinks to just £500 per year. Here's the catch: thanks to rising interest rates over the past couple of years, a growing number of people, especially those with savings in high interest or fixed rate accounts, are now exceeding that threshold without realizing it. This could mean that people who have worked hard to build up their savings might now face a surprise tax bill from HMRC, something they were never warned about, and something many people don't even know exists. Personal finance expert Laura Suter, Director of Personal Finance at AJ Bell, has raised the alarm. In her words, lots of people are using ISAs to protect their money from tax, or organizing their savings to cut their tax bill. But there are some sneaky tax traps that will catch some savers out without even realizing it. And these traps aren't rare, either. Let's take the example of fixed-rate savings accounts, which have become incredibly popular lately. With inflation having been a serious concern over the past couple of years, savers are locking in their money in accounts that offer a guaranteed return over a set period, often 1, 2, 3, or even 5 years. Now, on the surface, that's a smart move. You get certainty, you beat inflation, and you know what interest you'll earn. But here's where things can go sideways. Many fixed-rate accounts only pay out interest at the end of the term, meaning all of the interest you earn is suddenly accessible to you in one go. And from HMRC's point of view, that means all that interest counts as income in a single tax year. It doesn't matter that it was technically earned over 3 years. If you get it all at once, you're taxed on it all at once. Let's put some numbers to that. Suppose you put £7,500 into a fixed-rate savings account offering a 4.51% annual return, compounded yearly, over a 3-year term. At the end of those 3 years, your account will have earned roughly £1,061 in interest. Now, if you're a basic rate taxpayer, your personal savings allowance is £1,000. That means even if you don't have any other savings interest, you're already over the limit just from that one account. So what happens next? Well, any interest earned above your allowance becomes taxable. And if you've got more than one savings account, or perhaps a joint account with a partner, or maybe even a few premium bonds generating small amounts of return, you could easily find yourself racking up even more interest income, pushing you further into tax territory. And let's be honest, most savers don't sit down with a calculator and forecast their interest earnings every year. That's where the problem lies. People don't expect to owe tax on their savings. They assume their money is safely growing, not quietly triggering a tax liability. And the concern is growing because more and more savers are falling into this trap as interest rates remain high. Even modest amounts of savings, especially in fixed-rate accounts, can now breach the PSA. So what can you do to protect yourself? Laura Suter has a few practical suggestions. First, consider the timing of your interest payments. Instead of choosing accounts that pay interest only at maturity, look for ones that pay interest out annually or even monthly. Why? Because spreading the interest out over multiple tax years helps you stay under the allowance limit for each individual year. Let's go back to that earlier example. If you were to earn that same £1,061 of interest over 3 years, but it was paid out evenly each year, you'd be earning about £353 per year, comfortably below the £1,000 annual PSA for basic rate taxpayers. No tax would be due. That's a simple yet effective fix. Another solution? Use tax-free savings accounts like ISAs. Cash ISAs allow you to earn interest without paying any tax, regardless of how much you make. So if you're someone with decent savings and you're worried about the tax implications, a fixed-term cash ISA could be a perfect fit. You'll still benefit from a fixed rate, and your interest will be completely sheltered from HMRC. The annual ISA allowance is currently £20,000 as of the most recent tax year, so unless you're a serious investor or sitting on a large cash pile, you can easily move your savings into an ISA and stay tax-free. But don't assume you're automatically in the clear. One of the biggest mistakes people make is believing that if they haven't heard from HMRC, then everything must be fine. Unfortunately, the responsibility lies with you, the saver, to declare any untaxed interest if you go over your PSA. If HMRC does catch up with you, you could face backdated tax bills, possibly including penalties or interest if they think you deliberately avoided declaring the income. So what's the bigger picture here? This isn't about punishing savers for doing the right thing. After all, putting money aside for a rainy day or for the future is something we're all encouraged to do. But with more people saving and more interest being paid out thanks to high rates, the tax rules haven't kept up, and many people are being dragged into a situation they didn't expect. And with the Labour Party now in power, some analysts expect a tougher stance on tax compliance, especially as the government looks for ways to increase revenue without hiking income tax directly. That means more scrutiny from HMRC and potentially more letters landing on doormats in the coming months. So what should you do now? First, take stock. Review your savings accounts. Look at the interest you're expected to earn this year. If it's anywhere near the PSA threshold, consider moving money into an ISA or splitting your savings between accounts that pay interest at different times. Second, don't ignore the issue. If you think you've already gone over your allowance in the past, speak to a financial advisor or check your online personal tax account through the HMRC website. It's always better to declare the income voluntarily than to be caught out later. And third, and this is the most important part, don't stop saving. Saving is still one of the smartest things you can do for your future. But do it with your eyes open. Understand the rules. Plan ahead. And make sure your hard-earned interest ends up in your pocket, not in an unexpected tax bill. Thanks for watching. I hope this helped shed light on an issue that doesn't get nearly enough attention. If you found this video helpful or learned something new, please give it a thumbs up, and most importantly, don't forget to subscribe to my channel for more updates on money, taxes, and personal finance tips that could save you time, stress, and yes, even money. Stay informed. Stay smart. And I'll see you in the next video.